I'm joined by Richard Clarida. He's Pimco's Global Strategic Advisor, co-head of Pimco's official institutions channel, which oversees coverage of the firm's central bank and sovereign wealth fund clients. He's been with us throughout the hour. What changed within the past few weeks? We knew that the European financial institutions had exposure to debt and the possibility of default. Why does it seem to matter now that we're seeing some Spanish financial institutions experience some issues?
It's an excellent point, and something really did change, because until about a month ago, the view in the markets was that this was really a liquidity crisis in Greece and maybe Portugal, and the psychology of the market has now shifted to thinking of it really as potentially a solvency crisis. So you can't print your way out of a solvency crisis, and if really Greece and Portugal are unable or unwilling to pay their debts, then it becomes much more serious. And ironically, the size of the package that the Europeans put together, by some estimates nearly $1 trillion, if anything, drew the market's attention to how big the hole was. So in some ways a boomerang.
It was supposed to be the bazooka, though, that answered that.
The bazooka into the boomerang, yes.
Exactly. But, I mean, your point's well taken. You can't solve a debt crisis with more debt, right? But at the same time, I mean, are you saying definitively here that Europe has mishandled its crisis?
No, I'm not. I think it's a difficult circumstance, and I think that to preserve the euro, I think it was probably appropriate to go in with this size of package. But I think the challenge that Europe faces is that, and especially for the euro, there's no mechanism within the euro for a country to leave or to exit. It's sort of like the Hotel California. You can check out, but you can never leave. And I think the markets know that at some point Greece may have to exit the euro.
Why would they do that? The point has been made to me. Their debt's still going to be priced in euros. If they leave and take the drachma, their debt's still going to be more expensive.
And you're exactly right, so long as it's just a liquidity issue. But if they're truly unable to repay, it really doesn't matter. If you're going to default, you're going to default.
Do you believe that we are pricing in a default at this point?
I think essentially that's the way to interpret the price of Greek debt right now. It's pricing in a high likelihood of a default or a rescheduling scenario.
What are you hearing the most from your clients right now? You talk to central banks, sovereign wealth funds. Fear is begetting fear, some say.
Yeah, and indeed this was the subject on my recent trips, and particularly interpreting the developments in Europe and whether or not they need to rethink their view about the euro and the euro area. So that's definitely on their mind right now.